Welcome back to the Lifetimes webinar series. Once again, I have got Liz Koh, who is the director and founder of Enriched Retirement and a Kapiti Coast counsellor. Can you remind us, Liz, what your website is for Enriched Retirement?
Sure, it's enrichedretirement.com.
It's a great place to go and see everything retirement. We've also got Martin Hawes, who is a best-selling author and recently did Cracking Open the Nest Egg, which is fundamentally a great book to read as you're heading into retirement. And Martin, whereabouts can people get that book?
Oh, I think the old thing of any good bookshop, but you'd probably buy it online, and I think you'd be able to buy it online, and I assume it's in Kindle form as well, but I can't promise that.
Fab. Both Martin and Liz are well-known financial commentators across New Zealand, so we're really fortunate to have them with us today. Today we are going to be talking about the big hot topic, which is the banking failures over in America at the moment and actually globally. So we'll be breaking down what that means globally, what that means locally, and whether this could happen in New Zealand. First of all, we will do disclaimers as per normal. So the information given here is general and does not constitute as advice to any one person. Lifetime Asset Management is the issuer and manager of the Lifetime Retirement Income Fund. For further information, go to Lifetime Income for a product disclosure statement. We'll also note that Martin Hawes here is a director of Lifetime and a shareholder. And is there anything else we need to disclose today?
No, just that I don't think either Liz or I are financial advisors anymore. Both of us were financial advisors, but I've certainly handed in my badge, and I think you have too, Liz.
Yes, I have, yes, indeed.
So again, this is not personalised advice, it is general. So we'll hit right into what's happening globally. So obviously over the since the 10th of March, there's been a lot of noise in the papers around what's been happening, first with the Silicon Valley Bank, which came into collapse. Then there was Signature Bank. Then we had Credit Suisse. So I'm just wondering, Martin, could you just give us an explainer about what's been happening over the last 2 weeks?
Yeah, maybe it might take 2 weeks to do it, Justice. Yeah. Look, you have to understand that the very first thing about banking is that it relies on trust and confidence. Without trust and confidence, banks are nothing. I don't think there's probably a bank in the world that if all of their deposits turned up on their doorstep on Monday morning, that they would be able to pay them out if they were demanding their deposits. The bank doesn't take your money and store it out the back somewhere. Banks basically borrow short and lend long, and that means that they borrow from the public and they borrow from other places for relatively short periods of time. It might be 5 years, it might be overnight money. But in any event, it's a relatively short time. They take that money and they lend it out long-term for investment. They lend it to businesses. They lend it to households for a 25-year mortgage and so forth. So they're borrowing their money short-term and they're lending it out long-term. They are not keeping all of their money sitting there. So the banks are regulated about how much capital that they have to hold, and most importantly, the quality of that capital. And if anybody, and so that a good part of it needs to be liquid and relatively short term. The banks don't want to hold short term money because it means that they can't lend it out long term and make money from it. If confidence is lost, if trust is lost, and people start rumours that, whether it's social media or gathering to themselves, and a whole bunch of people suddenly decide that they need to take their money out of the bank, that's when the bank starts a downward spiral. And that's what's happened. We've got this Silicon Valley Bank and then Signature Bank. Both of these are small banks. both of these are regulated differently than they would have been regulated 10 years ago. In 2016, Donald Trump elected president. They changed the Dodd-Frank Act and made banks, so-called small banks, those with less than $250 billion, so they're really quite large, they're large by New Zealand standards. They made those banks regulated differently, and they weren't holding the right kind of capital. And in particular, the Silicon Valley one, which Silicon Valley Bank, which really started it all, was holding an awful lot in American treasuries. Now, American treasuries sound really safe, but in fact, they vary in value according to interest rates, and their value had fallen, and therefore people got suspicious about how much capital they had, how much capital they were holding, and started withdrawing their money. Long answer, but a short answer compared to the complexity of what's going on.
Yeah, and I think the key thing you said there was the American banks actually loan out for substantially longer on a mortgage than New Zealand does, such as, you know, if I was in America, I could get a home loan for 25 years and fix that rate that day. So that's a key difference in how we operate. Liz, do you have anything else to add there?
Well, I think you just the concept of you know, what happens with bonds when interest rates rise is worth exploring. So when you hold a bond with a certain interest rate attached to it, you know, called the coupon rate, if interest rates start to rise over and above what your coupon rate is, that decreases the value of your bond to basically, you know, make it the same as if you're now earning the, you know, a different interest rate on it. So, and it's a bit of a hard concept to understand really, but it's a really important one. So bonds have a resale value. So if you hold a bond with a certain coupon rate, you can sell that bond in the open market. And what it means is that if your the rate on your bond is lower than what the going market rate is, you will have to sell that at a discount, because otherwise it's not attractive to anybody. You know, someone else could go out and buy another bond at the higher market rate. So you have to basically sell it at a discount in order to kind of equalize the interest, the effective interest rate or the yield with the market yield. And so this is what catches people out with bonds. You know, they think that, you know, locking in a bond at a certain interest rate secures your investment. Actually, it doesn't. And unless you hold those bonds to maturity, but in between time, there is a change in value. And I guess it's one of the issues here is how that's reported. So in New Zealand, we use a principle called mark to market, which means we value the bonds at their value if they were to be sold on the market at that time, rather than hold it to maturity. And that, so if you value them in that way, you see a drop in the value of the bonds. And so, yeah, this is something that is a little bit hard to get your head around, but, you know, because we've always thought of bonds as being a secure investment, but they're not necessarily. They can change in value as the interest rates go up and down. Of course, the opposite applies too, that if interest rates fall, you can actually make a gain on bonds. So there is a bit of an art to investing in bonds. So that's just something to watch out for.
The interesting thing about Silicon Valley Bank, it had 20 billion tucked away in bonds and US treasuries, US government bonds, effectively. And when it couldn't raise capital, it needed some money, so it sold those $20 billion of bonds, and it took a loss on them of $2 billion. And people thought, geez, they've got $2 billion less capital than what they've been saying they had. And so the run on the bank started. And of course, runs are like a snowball. They get bigger and bigger as time goes on. As more and more people seem to have lost confidence, then it seems that I should lose confidence and I'm going to run to the bank to get my money out.
And I think the interesting thing about the Silicon Valley Bank is as we've heard, it was the place that, startups went to, and startups quite often had a lot of investments which would come in and sit in a bank. So the bank had a lot of depositors, but startups didn't really need to borrow because they weren't in that stage. So they don't have the borrowers to kind of even out the depositors, which meant that it kind of wasn't fully balanced out in the long run. In terms of it, so we've got Silicon Valley Bank is no longer. However, Credit Suisse has been kind of bought out and by the Treasury, is it?
It's been effectively merged in a shotgun wedding with UBS, which is the other big Swiss bank. They've hated each other for centuries, but they've been squeezed together now. They have to be the same bank, and they have to play nicely.
Yeah. And just from your guys, how is this different to 2008 when the banks got bailed out in America?
Who would you like to answer that question?
Yeah, I think it's quite different. The similarity is that there's a loss of confidence. But first of all, there's only 3 banks that have struck trouble, and we have banking difficulties sort of probably in the US, where they have hundreds of these so-called small banks and regional banks. There's always a bank having difficulty. There's been no contagion yet. There could yet be a bit of contagion. I'll come back to that in a minute. But there's been no widespread contagion, and that was really the one of the biggest problems with the GFC. But also with the GFC, of course, you had these mortgage products where a whole lot of mortgages were bundled together and given a AAA plus credit rating, the very best credit rating they could possibly get, and they were no such thing. So even though some of those weren't failing, again you get that loss in confidence.
And I think that was quite a widespread effect, wasn't it? Those structured credit products were being used on a global basis, and so there were a lot of people affected by that, including New Zealand investors. So it was on a massive scale, and what we're seeing here, I think, is a much more contained series of events that have led to some failures. So we're not talking, on the same scale as 2008. And I think also, just as you were saying earlier, Martin, just it's the regulatory side of it that has had an impact as much as anything. And, in America, it has been commonplace for banks to fail. I think one of the things we need to be grateful for in New Zealand is our very strong regulatory system here. It should hopefully give us a lot of protection going forward.
Yeah. Hats off really to Adrian Orr and his mates. I mean, those people catch a lot of flack for a lot of different things, but it seems to me our banks are extremely well regulated. What we should really say, though, is that one of the difficulties with this whole thing is that some US banks, for some deposits, there is a government guarantee. So if you put your money with a bank, up to $250,000 of your deposits with a bank are government guaranteed. New Zealand and Israel are the only major rich countries, OECD countries, that don't come with a guarantee. Now, government's got a bill before the House at the moment, but it seems to be taking it, and it's been going on for about a year that they've been going to do this, and that will be for $100,000. Now, one of the problems in the States was that because, as Chelsea said, the SVB Bank has a lot of startups. A lot of those people had major amounts of money. Let's say they'd just done a capital raise and they bought $100 million. And where do they put it? Well, they've got to put it into a bank. They put it into Silicon Valley because that's kind of the local bank. And of course, that's not government. $250,000 of that $100 million is guaranteed, but the rest isn't. And when those people started pulling their money out because they were getting a bit panicky, then that's when the little trickle turns into a torrent. And at that point, it's almost impossible to turn over to, to stop that run.
So,
It might be a good time to talk about what happens in New Zealand if banks get into trouble. Just to give the context around that, because we have systems here that effectively mean there would not be a run on bank funds. So you don't have to sort of get into panic mode and think, oh, should I race in and take all my money out of the bank before it falls over and get there first in line. So in New Zealand, we have something called open bank resolution, which under which if a bank gets into trouble, what will happen is the Reserve Bank will step in and appoint a statutory manager. And for a period of time, maybe 24 hours or so, all the bank assets will be frozen. And they will then determine on an ongoing basis what percentage of those assets would need to continue to be frozen in order for the bank to get itself back on its feet again. So once that's done, people can still continue to access their bank accounts. And that amount is at that point guaranteed once it's in that phase. And then what happens is they work out exactly how much additional capital, if you like, the bank needs to continue on. So first, of course, they dip into shareholders' funds, but then they may also dip into depositors' funds. So you may lose a percentage of your funds, which goes towards keeping the bank afloat. It's what they call the haircut system, and you may have heard that referred to. You have a banking haircut. So everybody might lose, say 10, 20, or even 30%, who knows, of their funds invested in order to allow the bank to continue to operate it. So it just means that it stops that rush of first in, first served. It means that everybody equally loses the same percentage, and then life continues back to normal. So hopefully that will stop a run on a bank. And the Reserve Bank will, keeps a pretty close eye on the banking system and their liquidity, their security. They produce regular reports on the stability of our banking system. And so you can be rest assured that they will be stepping in quite quickly should there be an issue.
Martin, do you have anything to add into that?
No, just that it's a very good system. I have a lot of confidence in the Reserve Bank and their regulation of the banking system. I think we really need it because we don't have a guarantee of any sort of guarantee of deposits. I would say to people that they need to be very careful about which bank they go to. There's a tier of banks which are all rated, have a credit rating that's fairly similar, and it is towards the top of the tree. Now, if you've got the money that you just got from the sale of your house and you're about to buy another one, and that money is absolutely critical to you, I would be demanding that you put that money in one of the major banks who have that top credit rating. Fairly easy to look up the credit ratings. The only catch is that there are 3 rating agencies, and some banks use one and some banks use the other, which makes it and they have different scoring techniques, so it's a little bit tricky. If, on the other hand, you are just looking for a better return and it's just like any other investment, then you might go down the tree a little bit, down the rating scale a little bit, and try to get another half or another 1%. But, cash usually is something that we want to be kept as safely as possible, and that means that you need to be up with most of your money, at least in one of the majors where the rating is good.
Just on that point too, Martin, credit ratings can be a little bit misleading. So those major banks that we have, Westpac, BNZ, etc., they're on a AA- rating, most of them. Then you've got a couple of banks like Kiwi Bank and so on that are just an A. And then there's quite a big jump down to banks like Heartland Bank, SBS Bank, Co-op Bank, which are around the BBB mark. Now, when you're at school, you think, oh, a B grade, that's not too bad. That's just one step below an A. But it doesn't actually work like that. And we have to remember that during the global financial crisis, a lot of the finance companies that fell over had BBB minus ratings. And the thing is that as you move down the scale with credit ratings, the risk increases exponentially. So going from a AA minus rating down to a BBB is a huge increase in the risk that you're taking. So I think, you need to think very carefully at the moment around how much money, if any, you divert to banks with those BBB ratings. I think in this kind of volatile world, unless it's money that you don't mind taking a bit of a risk on, you're probably better to stick to the safer end of the spectrum. And if you go to the Reserve Bank website, there's quite a good explanation of credit ratings. The Reserve Bank website is rbnz.govt.nz. If you go to there and do a search on credit ratings, you'll come up with a very useful explanation of how they work so that you can really get a good understanding of the risk that you're taking. And if you do want to check out bank credit ratings, there's a very good website, interest.co.nz, that you can go to that sets them all out in a table so you can see quite clearly each bank's credit rating and also the interest rates they're offering. It's quite a good kind of marketplace, if you like, for bank deposits, so you can compare. But yeah, please do be careful as we go forward, because we're certainly not out of the woods yet.
But never think that it's impossible, no matter how high the credit rating, it's impossible for a bank to go under. I mean, if you'd said to me 10 years ago that Credit Suisse was going to have banking trouble and be on the edge of a run and having to be sold into UBS, I would have sort of said you were talking fairy tales. It just wouldn't have seemed possible for a major global institution like that. I've listened to all sorts of things and read all sorts of things recently. But I was listening to something this morning, and that was talking about the suggestion that there should be in all banks and all countries a 100% guarantee of retail depositors, so that you don't up to as much money as you want to put in, so that they are guaranteed. Now you get moral hazard then, so you might think, well, the bank just needs to can just fall asleep on this and not bother about it. But really, what you ultimately you need would be absolutely first-class regulation of it, like New Zealand has. So, the regulator would need to watch over the banks very carefully. But if that happened, you would get a situation where we had complete confidence in our banks and a bank wouldn't fail. And a bank failing or particularly a contagion of banks failing, is really, really damaging to the economy. Even the small little thing we've got going on now, I'm assuming it's not going to spread. I doubt, it may spread. There'll probably be a few more that people start scrutinising, and therefore they have their difficulties. But they will largely be these US regional banks, I think. That the idea of it spreading to New Zealand is very unlikely. But if you had that 100% guarantee on all depositors, nobody would be ever bothered by this. It would mean your deposit rate would be, your interest rate would be lower, because it's got to be a cost somewhere. Someone's got to bear it. But I think that's an idea well worth thinking about and exploring.
I guess the other thing to touch on too is just the nervousness that all these failures have created in the markets, and that reflects also in the share market as well, because obviously there are some investors and funds with exposure to some of these banks, and it just creates that fear. And we all know that when investors are fearful, that creates increased volatility, and we're certainly seeing that. So even though it's happening in the banking sector, there is a flow-on effect through to the share market in terms of increased volatility. So, but that, that's likely to pass. As this unfolds and the fear subsides, that will return back to an even keel. So we just have to hope that nervousness and contagion doesn't spread too far.
And if this did get big, and I don't think it will, but if it did get big, or in the areas that it may get big, like, it could be Wisconsin or Pennsylvania or somewhere like that, where there's a bunch of regional banks which strike difficulty, a failed bank is not lending to its customers. And that's an so businesses can't meet payroll, or they can't invest in new plant equipment. They can't maybe hire new people if they're not able to secure a reliable overdraft, for instance. So it does this, we have to have a secure, a firm, a safe financial system, or we are in all sorts of trouble. But as far as New Zealand goes, I'm keeping my money in the bank, and I sleep very well last night.
That was exactly my question. As a normal person on the street in New Zealand, you speak about our banking regulation being quite good, what the RBNZ has put in place. So we can sleep well at night at the moment. The contagion spread to New Zealand isn't, we're not expecting anything at the moment. And looking to America and what is going on with those regional banks is their regulation back in 2018 was stripped right back down to, I really like a quote from Elizabeth Warren, where fundamentally she was on the news talking about the fact that those regional banks had their own internal quality controls. But as she said, as a teacher, she's never let her students test themselves. And that's fundamentally what it came down to. So those regional banks do operate very differently to what New Zealand regulation is here today. Is there anything, you talk about 100% guaranteed for depositors, which would be a great thing for the government to put in place in New Zealand. Is there anything else we can do at our banking regulation to make it safer, or have we got enough there today?
As far as I can see, I think we have plenty. I've read, and I listen to a lot of podcasts. I've read and listened to so much in the last couple of weeks, really. I have seen nowhere somebody saying this will be a contagion which will spread through all the banks in Europe or all the banks in the US. And I certainly haven't seen somebody saying this will come to New Zealand.
I think the key thing here is, as we've been talking about, is just be aware of the credit rating of the bank that you're using, and just play it safe. That's the message going forward, just while this particular period is working itself through. Just play it safe.
Excellent. Is anything else you guys want to say on the subject matter, or shall we wrap up another webinar? All good? So thank you both, Liz and Martin. This webinar was brought to you by Lifetime Retirement Income. We do retirement income solutions, so please do go to our website, lifetimeincome.co.nz, and design your retirement income today. Thank you very much.